What's going on, guys? It's John Dionk here, and today I want to talk to you about borrowing capacities, what the recent changes to assessment rates have been, and what are the things that you can do to try and increase the amount that lenders will allow you to borrow. If you're unsure what your borrowing capacity represents, simply put, it's just the maximum amount a lender will allow you to borrow to buy a property, and it's put into place to prevent you from borrowing more money than you can afford. There are a numerous amount of factors that are going to impact on that total figure of your borrowing capacity. And it actually varies between lenders because they've all got their own calculation techniques and risk mitigation methods. One of the biggest factors is going to be your assessment rate. And it's easy to presume that the interest rate that you get on the package they've offered you is going to be the rate that they assess you on. However, they actually put a buffer on top of this interest rate as a risk mitigation method. For example, say you applied for a home loan package on a 3.5% interest rate per annum for a $400,000 loan. When you go to calculate your interest repayments, you calculate it at $14,000 a year or $1,167 per month. With a buffer on top of this, lenders may assess you on something closer to 6% per annum. So for the same loan, you'd be assessed at having to repay $24,000 a year or $2,000 a month. This is a massive difference of $833 per month. And lenders evaluate you on this higher assessment rate to ensure that you can continue to repay the loan if interest rates were to rise in the future. With a higher assessment rate, it means a higher loan repayment calculation. And ultimately, it's going to decrease your borrowing capacity because between your income and your expenses, there's only so much you can afford to make repayments on. If you haven't already, don't forget to smash that like button as it seriously helps out with the YouTube algorithm. While this interest rate buffer may seem like a little bit of an overkill compared to what we actually need to make repayments on, the Australian finance regulator, known as APRA, has recently just loosened the criteria on assessment rates. Since 2014, APRA has required that all lenders assess loans on the greater of either a 7% assessment rate or a 2% buffer on top of the interest rate. On the 21st of May 2019, APRA removed this as they believe it is no longer required. Lenders can now enforce their own buffers and serviceability floors, although APRA has proposed to all lenders that all their assessments should include at least a 2.5% buffer on top of the interest rate. A serviceability floor is just the minimum rate that lenders will assess you on. For context, on the 30th of September 2019, Westpac dropped their serviceability floor down to 5.35%. So as a hypothetical example, you go out and apply for a home loan package on a 2.5% interest rate. Including APRA's proposal to include at least a 2.5% buffer, your assessment rate should be 5%. However, because this is below the serviceability floor, you'd actually get assessed at 5.35% instead of 5%. Lenders play around with these floor and buffer rates in hope of getting some media attention, promoting how competitive they are against other lenders, and hopefully enticing you to go to them first when you need a loan, hoping you forget the fact that you actually do need to make the repayments on the loan. And behind the scenes, lenders are becoming much more tighter when it comes to calculating your outgoing living expenses. So it's kind of like they're showing you what they're doing with the left hand, but secretly behind the scenes they're playing around with the outgoing living expenses. So although it may seem like you can borrow much more on these lower assessment rates, lenders are now thoroughly checking what your spending habits are. And if they see something they don't like, they may deem you unable to service the loan. We have to take the good with the bad here. And all in all, it's believed that borrowing capacities have increased by 15% since the APRA changes and the multiple rate cuts over the last 5 months. This means that now you may be able to get approved for a loan that you couldn't have previously. But just remember, with a larger loan amount on the same LVR, you're going to need a bigger deposit. In today's lending arena, a good rule of thumb to calculate your borrowing capacity is to times your income by 6. So if you earned $80,000 a year and times it by 6, you should be able to borrow somewhere around $480,000. According to the Australian Bureau of Statistics, as of May 2019, the average Australian weekly income was $1,633. This is just shy of $85,000 a year, and using the previous rule of thumb, the average Australian should be able to borrow about $510,000. The ABS has also reported in June 2019, the mean price of residential dwellings was $638,900. This limits the ability to borrow that amount of money to the higher than average income earners or couples with double income. This is why the first property you buy is the biggest financial decision of your life, because we've only got one shot before maxing out our borrowing capacity. And if you can't find a way to get out of the market, your whole borrowing power is going to be locked up in just the one asset. Growing up, I would read Steve McKnight books cover to cover. With titles such as 0 to 130 properties in 3.5 years, who wouldn't? I would still highly recommend giving these books a read to understand the fundamentals of property investing. although just remember that some of the regulations have changed today. I'm still baffled about these numbers, and it almost feels like they had an unlimited borrowing capacity back then. I'll read an extract out of his book which explains how this was possible. The way to get around reaching your borrowing limit is once ABC Bank has said no more, you can't borrow anymore, create a new trust structure and approach it with a different bank, which will then provide you with a further $300,000 to invest with. How is this possible? Well, as long as the loan is not in default, the debt to the ABC Bank is owned by the trust company on behalf of the trust. You have no personal liability and do not need to record the guarantee on your personal financial statement. After discussing this method with my broker, he explained that although it may have worked in the past, he doesn't believe it will work under the new open banking and POSIT credit reporting we're now dealing with. With a trust account being set up to borrow finance, you do need to offer your personal guarantee. And this guarantee needs to be disclosed at all times when applying for any further finance. With the new changes coming into play, it's likely that all lenders will have full access to all of these details. Investigating further into these, open banking will give you more control on the data that lenders hold on you, and will allow for you to ask for your data to be sent to another lender. On the 1st of August 2019, open banking legislation was passed in Australian Parliament. The Big Four banks will need to provide access to both your product and customer data by July 2020, including any credit cards, personal loans or transactional accounts you have with them, and all other lenders will have to provide this data after that. Comprehensive credit reporting, also known as positive credit reporting, is Australia's new credit reporting system, and it's aimed at making it easier for lenders to do a comprehensive and balanced assessment taking in your credit history. The report includes information about accounts held, what accounts have been opened and closed, the date that notices have been paid, and whether the repayments were met. Now, this isn't financial advice, and I'd highly recommend going and speaking to a mortgage broker about your current situation, but here are some ways that may help increase your borrowing capacity. Try different lenders outside the Big Four banks. As discussed before, all lenders have their own calculation methods, their buffers on top of their interest rates, and serviceability floors. So you're going to have varying borrowing capacities between different lenders. Go out and get your credit score. Lenders will check your credit score whenever you apply for a loan. So by understanding the current position of your credit score, you may be able to pick up on any red flag items that lenders will identify as being a risk. You can also address any of the issues that have been reported incorrectly. Pay off your debts. The interest on your credit cards and personal loans all impact heavily on your outgoing expenses. So by reducing these bad debts, your outgoing expenses will come down and it should increase your borrowing capacity. Increase your income. This is fairly obvious as the more you earn, the more debt you can service, and lenders will view you as being able to service a larger repayment. Reduce your living expenses. Sit down and go through the last 3 months of your spending transaction history. Identify any of the excess spending that may be impacting on your living expenses, such as spontaneous shopping sprees or $40 a day for 3 coffees and lunch. Reduce excess limits. Once you've paid off your credit card, you should close it down completely. Or if you can manage to pay it off in time, reduce the excess on the limit. So if you've got a $15,000 limit, reduce it down to $3,000 and pay it off monthly. Save a bigger deposit. With the ability to save more money shows lenders that you've got a clean, consistent saving record, and it demonstrates to them that you've got the capability to make monthly repayments. Split liabilities. Be careful when splitting liabilities with your partner. If you only own 50% of an asset, lenders may consider you 100% liable for the debts, while only taking 50% of the income or rent from the asset. This only works when you can prove that your partner can and will service their portion of the debt. If you're buying with your partner, apply for the loan in one individual's name and have all the monthly outgoing living expenses in the other person's name. This increases the borrowing capacity of the one individual. If you're rent vesting, put the lease in the lowest income earner's name so it doesn't impact the larger income earner's borrowing capacity. Although banks will need proof that the lower income earner can service that rent. Take a longer mortgage term. Increasing from 25 years to 30 years, or even 40 years if possible, increases the life of the loan and it decreases the amount of monthly repayments, allowing you to service more. Just know that if you increase the life of the loan, you're going to be paying more interest over that time. I want to know what other methods you guys have used to increase your borrowing capacity. Leave it down in the comment section below. As always, seek your own professional financial, legal, and property buying advice. These videos are just my opinion and should never be considered as personal advice. If you're keen for more content like this, hit the subscribe button and the notification button so you don't miss a video. And until next time, happy house hunting. It It'll allow you to ask to send data to other lenders. Man, this is where I hit a wall, eh?